Hey everyone, this is Corey with Sims Investment Management. This is another monthly market update and coming to you a little bit later in April because we were just so slammed with tax season, which we are very thankful to have behind us. We talked to a lot of you over the past several weeks and months, and we appreciate all your coordination and help as we tried to help you with tax minimization, moving money into Roth IRAs, backdoor Roth IRAs, and tax documents and everything else. So we're glad to have that behind us. We're also trying out a new marketing newsletter system. So if things look a little bit different this month or out of place, stick with us as we figure out how to use this new newsletter service. A lot has happened over the past several weeks in the market, including the March kind of bank mini crisis, if we call it. So Silicon Valley Bank and a couple other regional banks that fell on hard times. And we did our best to send out some articles on this to some clients that expressed some concern. But there's going to be some other resources in this newsletter that I highly recommend. Charles Schwab was in the news a little bit, and some clients were concerned with what their financial stability is. And there's a really good resource in there too that talks about how Charles Schwab protects your money, the FDIC versus SIPC insurance, and just for some peace of mind, Charles Schwab is the seventh largest bank in the United States. They're one of the top 3 brokerage firms, so a really great place to have our clients' assets as their custodian. Silicon Valley Bank was super fascinating because if you think about 2008, 2009, the issue was really driven by the quality of the assets that banks had on their balance sheet. And this had nothing to do really with the quality. Silicon Valley Bank had really the highest quality bonds you can buy, which are U.S. government bonds. But they also had a greater than 50% of their loans were to tech and healthcare startup companies. And once they started to have depositors start coming to claim and take their money back, they either had to try and sell loans that were not very marketable, because who wants to buy failing debt for tech and healthcare startup companies, or they had to sell government bonds. Government bonds of very, very high quality, but that were longer. And with rising interest rates, like we've talked before, when interest rates go up, bonds lose money. A very easy way to think about that is if I have a bond today that's a 3-year bond that I'm buying for 5% interest, but you bought a 3-year bond last year for 1% interest, well, if you need to sell that bond that you bought last year, I can either buy a new bond at 5% or I can buy your bond at 1%. Well, I'm probably going to go buy the bond that's going to be paying me 5% unless you're willing to sell your bond to me for a discount that you bought last year. So that's essentially what Silicon Valley Bank was having to do. They were having to unload government debt at a discount, at a loss, because interest rates have risen so much in the past year. And bonds can be a really great place to be when interest rates are going down. But when interest rates are going up, bonds lose money. There's no ands, ifs, or buts about it. So hopefully that's a little bit more on Silicon Valley Bank, how it's a little more unique. Ironically, the big banks ended up benefiting greatly from this as depositors started to move money to the likes of JP Morgan Chase, Bank of America, and even some more of your regional, more stable banks that people have confidence in. I think what's also just like from Banking 101 that people sometimes might forget or realize is if you think about banks, they typically, might be somewhere between 10 and 20% collateralized. So what that means is if you have $100 million of deposits in your bank, you might have gone out and issued loans of 800, 900, or maybe $1 billion. And so you have to keep a certain ratio of deposits versus your loans. And if people start taking their money out and your deposits are going lower, you have to then start selling some of your loans in order to keep those ratios constant. And if your loans are not very marketable, like Silicon Valley Bank, then it puts you in a really tight spot. So I think sometimes clients or people just don't know, banks don't have a dollar for dollar between deposits and the amount of loans that they have. And that's really what can drive inflation, and why the Fed is trying to raise interest rates is they're trying to get banks to stop lending so much money, because if you don't lend, that reduces the amount of money that's in the economy and can hopefully bring some prices down and slow down inflation. So I know that's a lot. It's a little convoluted. I'd love to talk to you about it more if you have any interest. We have some really, really great resources this month, courtesy of the entire Sims Investment Management team. I do not put this all together myself. So please check them out. And we'll see you next month, hopefully a little bit earlier in the month. And please don't hesitate to reach out with any questions. Please also forward or send this along to somebody that you think it might be helpful. Thanks.